Hi, everyone, and welcome to Macro and Global Liquidity Analysis, Gold, Silver, and Bitcoin monthly update for August 2024. We're putting this presentation together for our valued clients of the Ainslie Group, which includes Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard. First of all, let's welcome our expert panel for today. We've got Joe and Paul. How are you going today, guys?
Very good. Thank you, Chris.
Good, Chris. Thanks, mate. Thanks. Great to be back.
Well, we seem to be saying every month that a lot's gone on. I'm very interested in this month because we've been waiting for a long time for really this green tick up, this little moving liquidity that's happened. So we'll get to that in just a minute. Lots to discuss. But before we do, just a reminder, with everything that we say in this analysis, it's intended for general informational purposes, does not take into account your particular circumstances, objective, or situation, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. Alrighty, so we'll follow the same format we have been, because we'll be getting, and thank you to everyone who's been providing that excellent feedback we've been getting across the platforms. Really appreciate that. It's great to see the audience is really valuing the stuff we're doing here. It motivates us to get back into it each month. So thank you for that. But we'll follow through that format, looking at the big picture macro, then looking at the liquidity cycle, because we'll show how that drives the macro cycle, other indicators and where we think they point to in the cycle. Then we'll look at some specifics in terms of how you take advantage of that through things like Bitcoin, gold, and silver. So we'll start off with the big picture, where we are in the global macro cycle. We've been waiting for this green dot here for quite a while to really pick up, because it's been dragging across the bottom. Paul, I'll start with you on this one. Every month we've had to come back and say, look, it just hasn't really kicked up into that what we would expect to see in mid-cycle. Is that what is happening now?
Yeah, and look, we've spoken a number of times about the Chinese bear just holding this back. It was the outlier, and is certainly back with the vengeance. So we're back to where we would have expected to be honest, in this part of the cycle. Again, we're still below that dotted line, so we're not yet beyond that expansionary part of the cycle, but it's certainly on the right trajectory.
And Joe, if you strip China out, because Paul's just made a very valid point, if you strip China out, we'd actually be higher again. But I think the jump in 1 month really shows that when global liquidity does pick up, it can move quite quickly.
Yeah, and we've seen that reflected in asset prices as well, particularly when you're looking at risk assets such as stocks and in gold. Gold's performing fantastically. Sniffing at the money printing and the monetary expansion base it's about to begin. We'll talk about it through this episode, but as to reasons why. But Bitcoin is not going to be too far behind, I imagine.
And I mean, this chart is of the global macro sort of cycle, so we can see that mid-cycle we've been talking about quite a bit. We argue quite strongly that is being driven by the global liquidity cycle. This chart has also been a favorite of people, particularly online, really showing very clearly over a long period of time, back from 1970, that you just get these lows and highs consistently time after time. We have now seen quite a substantial tick up here. Paul, we were talking about this the other day. The last 20 years or so, every one of these lows has led to some form of banking crisis, hasn't it?
Yeah, that they've effectively been a crisis born of refinancing, right? So as we cross that Rubicon of I guess monetary policy dominance into fiscal policy dominance around the GFC, we've really entered this space where it's all about refinancing. The sheer scale of the monetization of these deficits and the accumulation of that debt means it's that the debt tail is wagging the economic dog now, for sure.
And people can go read a little bit more about those historical sort of causes and consequences of those cycles. But it was just a really interesting point that you've sort of made there, that it's been very consistently resulting in banking crises, which has forced a response. I mean, we've seen quite significant responses generally to all of those things that were on the previous chart. But when you look at it now and see that global liquidity really starting to pick back up again, Joe, are we out of the woods there for the banking crisis? Because I don't really know how to think about that. Was it when we started to see the issues with the banks in the US? Was that sort of our crisis flashpoint for this cycle, or can more still happen where we are down here? How do you view the potential for more damage to come, or are we past that now?
I think there's always the potential for something to happen, that those sort of black swan events. But if you, generally speaking, you don't have these crises when liquidity is abundant or is becoming more abundant. They generally happen at the bottom of these liquidity cycles. So, it was a couple of weeks ago when the Japanese yen trade was blowing up. I'm sure everyone's heard about it. Risk assets were selling off. We were looking at our metrics, our macro indicator, our liquidity indicators, and saying this just isn't the top of the market. We weren't in fear of any bear market eventuating. A lot of panic as Bitcoin and gold was held quite strong, but in terms of Bitcoin and the stock market, they were selling off quite violently. But based on where we were, and we know that the liquidity cycle had already bottomed a couple of years ago, and we're heading in the right direction. For us, we weren't really phased by that at all. We had quite high conviction that markets would turn up again.
It was a great test, wasn't it? I mean, that yen carry trade is a financing, trade. Like it's a whole lot of debt, borrowing cheap and deploying for yield. So it was a great test. It was a big test, and we saw a lot of volatility. But again, holding to this, as Joey just said, when you've got a strong thesis and you know what you're looking through, it goes a long way.
And you can identify those points as buying opportunities. So it's when you've got conviction and you've got excellent indicators like we do, it's just pure opportunity to buy those assets cheaply.
I fully agree. And when we said, Paul saying it was a big test, it absolutely was, but it was great. It was a great feeling to come out the other side of that going, well, okay, we know we're not at the bottom. And that's why I was sort of asking that question. Could more happen? It probably could. It always can around those lows. That is the danger zone. But even if it had, we were fairly sure of the response that you're going to get at this part of the cycle. So that was really encouraging, I think. When we tend to look at the sources of global liquidity, you can see, we've gone through this period here where we had that pullback, but we know it's going to go up and to the right. That's what global liquidity does. Central banks are going to respond, and ultimately that's what we've seen going on. I think another metric, and either of you who wants to speak to this one certainly can, looking at this and being able to see the move out of this really negative red period that we had where liquidity was being drawn out of the system, similar to that previous chart, it hasn't been solid green yet. We knew that we were heading in that direction, but you could probably argue we're starting to see more evidence of that now.
Yeah. I think it paints a fantastic picture when, we look at statistics, we look at numbers, we look at indexes, but when you can visually see the chart or see the statistics in plain colors, you can see that it's a slow moving beast, but you can see over time we're heading into a period of green where liquidity is going to be expanding again. And
you can see one of the last remaining near reds is the US. So
yes.
So hence, the global fixation on the Fed. We've got Europe, almost in lockstep. They're coming out of the red and heading into that green area. China, likewise, has been the other big one at play. But really, of any importance, you can discount Argentina. The US is still the one that is still in that light shade of red.
And such a good point, because obviously the US is important, but when you look at what's actually happening across the globe, we can see the direction quite clearly for everyone else except the US. So a very important point. When we look a little bit further into other metrics that form the foundation of what's going on with that macro cycle, we just want to see, we're really just looking for confirmation or lack thereof. And we got a little bit of a mixed bag this was at the start of August, where we got the ISM number really quite confusing down here, because we had, or not confusing, but concerning to the market. There was a lot of negative sentiment around at that point where we saw that coming down. And then a few days later, we got the services number pop up to the upside. Joe, what was your take around that period of time, and what can we sort of expect going forward from your view on that?
Well, you're right. There certainly was a lot of, I would call it stagflation commentary during that period of time where growth was falling, but inflation was rising, when we've been basically calling the exact opposite. Now, growth hasn't exactly exploded higher. It's sort of still bouncing along the bottom there, but albeit a neutral rate. It's important to know that this chart and even the next chart with the 3-month leading indicator is still going to lag behind global liquidity. Global liquidity will pick up first, leading the markets, which will then lead into the real economy. And this is just a reflection of the real economy. So this will eventually pick up. We don't see any recession or recessionary fears on the horizon. We've been saying that for quite a while a lot of other market commentators have been fearing the recession for the last 18 months. But like I said, it's a slow moving beast, and it'll pick up along with liquidity in markets later on in the year and into next year.
And you need to look at this in conjunction with that red line in the previous, with the US. This is
Yes.
US data, right? So, so what this tells us is absolutely, it's a lackluster economy at the moment, and the Fed has two drivers. It's inflation and unemployment, and the figures behind these ISMs, and same with the NFIB, were pretty weak employment. So the Fed has everything now in its arsenal to then go and start loosening policy. So it's not disastrous, but it's bad enough that the Fed will come to the rescue, and we'll see that red turn to green pretty smartly.
And you just highlight that point, Paul, and sort of to follow up on that with the inflation data. We've been arguing this for a long time, but that's well and truly our leading indicator, at least, is well and truly below that 2% line, which has always been the target. Is that what you're expecting really gives them the green light to go ahead and start easing rates in the US? Because inflation, you could almost say, is not in the picture anymore.
Absolutely. It's that was always their catch-22, is they could see the weakness coming, right? But and they were just holding because if they went loose too early, then you would see an uptick in that inflation, and they couldn't see that particularly into an election year.
Just more on that. So exactly what Paul's saying in terms of inflation. We've been quite adamant that the inflation is going down, but what we don't necessarily show in this presentation is the jobs report. So we had a massive revision last week of, I think it was negative 800,000 jobs for the previous month, and now that the Fed are reasonably happy with their inflation target, everyone's basically looking at these job numbers, which will come out next week, and if we get a very soft report on that, there's quite a high chance, in my opinion, that we won't be going to a 25 basis point cut. We'll be going to a 50 from the Fed.
And I think that's a perfect segue into this next section, looking at the debt and specifically bond yields, because they actually tell a story when we're talking about unemployment and inflation and growth, really all combined together. Because there's the old saying that the bond traders are the smartest guys in the room, but it's not so much that necessarily. They've certainly got it wrong a lot recently, but the market itself tends to paint a picture. We've got, if you look at it over the last 30 years, we've clearly been through a compressed and choppy period of time over the last few, but really zooming in is where it starts to make a little bit more sense. We've had peaks and sideways action now for a number of months to it almost a falling situation happening here. That doesn't necessarily line up with the ridiculous debt that we've seen, and that just keeps continuing to grow, and the persistently high Fed funds rate that's just stayed there for a really quite an extended period of time. Paul, what's your take on that? Is it that ultimately this has to force it lower, but you would argue with many, there's many reasons there to push those yields higher over the longer term with the debt situation as it is, or particularly if inflation came back, even though we're arguing that's not an issue right now. What's your take generally?
Look, there's a lot in this one. So, you talked earlier about the shadow monetary base in terms of what drives that in global liquidity, and yes, volatility is up in bonds, and that tends to reduce that collateral multiplier. But the collateral itself, lower yields means higher value bond. So the collateral itself is going up. So that's literally liquidity into the system. But then we're also still looking at a yield curve that's a mess, but still inverted on some basis. And again, because of that big black line where they just keep creating more and more debt out of more and more issuance, well, they're issuing 2-year bills. So that's literally forcing that market to behave in that way. So and then the other side is they need interest rates lower because they've got so much debt.
Yes.
So at some stage that red line has to come down, and all but that's a long way to go. It's at 5.3, and those yields are around mid to high threes. No one's factoring in that much in September. They might be factoring 50 basis points, but not that much. So it's still a very disconnected market, and you could argue the reason why the smartest guys in the room, the bond traders, aren't so smart lately is it's not a natural market. So Janet's absolutely monetizing their deficits hand over fist into the 2-year bills, and that's just distorting the whole picture.
And such a good point, because that manipulation is very clear, and it just shouldn't. You can understand why people are getting it wrong, because it shouldn't be behaving the way it is. None of it really makes a whole lot of sense. Is that part of what this next chart is showing, that there's that manipulation going on in anticipation and potentially driving a fall in the US dollar as well? I don't know how you want to approach this, Joe, but I know we've had lots of discussions around the US dollar, specifically looking at the fact that for everyone else, its liquidity increasing when the US dollar falls, because obviously that boosts the value of everyone else's currencies. How do you want to approach this? What's your take on the dollar here? Is it being deliberately pushed lower? Is it going to continue? How are you viewing it?
Well, we're certainly reaching a point in time where if it breaks that 100, you would expect that to continue down. Back to your point about the strength of the US dollar affecting other economies. So the world has a large US dollar denominated debt, and obviously the higher the value of that dollar means that their own native currencies, they spend more on servicing debt than they can in investing, growing their own economies. So it's definitely a pivotal point, and that's something we're just going to have to watch. But it's basically, from my perspective, from a world view and world central bank view, if you're talking about other nations where they would like the dollar, it's really in everyone's best interest to have a lower value dollar at this point in time to kick off the economic cycle in the world, the global economic cycle again.
And we'll dig into that specifically in just a couple of slides' time about what might be going on to force the issue. But we have been looking at weekly liquidity more recently to see if it supports where we think we're heading. You've seen a big kickoff here, really quite substantial, to get us out of the what you kept referring to it as sort of the wobble, or what was the word you were using?
The air pocket.
Air pocket, yes, thank you. So we had that air pocket, well, really a couple of air pockets there where it wasn't going higher. We were expecting it to go, and then this is what it looks like when it does go. I think looking at that through the lens of what we were just discussing with the US dollar, very curious on your perspective on this, really, of what might have been going on behind the scenes. This was some work done by Michael Howell from Cross Border Capital, potentially arguing that we might have just been through something very similar to the 1985 Plaza Accord, where there is a very high level of manipulation going on in what happened with the yen. Joe or Paul, whoever wants to sort of attack this one, really quite interesting to think about.
Yeah, I'll go. I wasn't around when this took place, but basically in 85, 86, the Plaza Accord is the US dollar is extremely strong, and it was limiting growth around the world generally, just because, like we spoke about before, if the US dollar is strong, then other countries with US dollar denominated debt have problems servicing that debt, and it really slows down the world economy. So a bunch of nations got together and decided they're going to artificially devalue the dollar. So going forward from there, as you can see, the US dollar, well, it's not showing you, but the US dollar weakened, which allowed liquidity, like global liquidity, to start ticking up, which was a fantastic time for asset prices during that period. You're referring back to the current cycle with the yen, which has been the devaluation of the yen over the last 6 to 12 months has been unprecedented in terms of markets don't usually behave in that way. It seems to have been a deliberate act to devalue the yen for geopolitical reasons, mostly suspecting that because Japan's a export competitor with China, it forces China to effectively lower the value of their currency as well, which puts them in a bit of a tough spot. So going forward, if we're following this same sort of pattern, we'd expect the US dollar to continue weakening and global liquidity to flow.
And Chris, I think you raised, it was only a few of these ago that we were openly discussing, or Joey might have been you, Janet Yellen, making a number of trips to China around this time. It's even the Plaza Accord wasn't official. I don't think it's and likewise this it's and as Hal said when he posted this, markets don't move like this naturally. There had to be some sort of intervention. It seems to have worked beautifully. So there was certainly a weaponization of the yen, and that probably had its intended effect. But there are few players now that benefit from a strong US dollar. So they seem to have had the meeting, and if it's anything that we saw like last time with that 81 to 89, you can see that it's following it reasonably well, and we could expect to see the resulting liquidity that came out of that repeated.
And such a good point. The markets don't do that by themselves. Like those moves in the yen were extraordinary. People just go, oh, well, you go through periods like that. Well, you don't really. There's no players big enough in the market to actually move currencies that trade literally trillions of dollars a day, because they're obviously derivatives and there's a lot going on there. No one individual entity could do that. Governments are the only ones who could really do that. So it does lend a lot of weight to that argument that it was a very deliberate intervention by some big players.
Particularly when you look at Japan's foreign reserves, like they could have strengthened it effectively at any time they wanted. They decided to let it run for quite a large period of time with no intervention at all. So we obviously got an intervention around 160 around the top, and a lot of people got liquidated. But yeah, it certainly seemed intentional. They could have done something about it earlier if they were really worried about it.
And a whole lot of us got to go skiing in Japan for a lot less than it normally costs.
Yeah.
There are some benefits for us here in Australia, that's for sure. But we'll keep watching that, because it's one of those things that will probably come out in the future as being quite clearly what was happening, but you never know about it in the moment. So we put all that together to look at how we should be allocated, particularly when we, from our perspective, look at Bitcoin, gold, and silver. Now, to reiterate the point, we have a very strong correlation with global liquidity and world asset prices. Global liquidity drives world asset prices and has done for as long as we can look back at the data. So that's quite relevant. We also have identified over a number of months when we've looked at this chart that we can see clearly global liquidity heads up and to the right. We know that's the case, and gold and more recently crypto, when that's been added to this mix, reflect that. Really, the point we keep making is that they don't keep up, or global liquidity outpaces CPI inflation, and that's really important to understand that difference. I might actually just to reiterate for people, Paul, if you could maybe just speak about that, the difference between consumer price inflation and asset price inflation, what we're actually seeing on this chart.
Yeah, it's a stealth tax, right? So so for so long, people talk about gold as being an inflation hedge, and they simplistically look at CPI, but where its true value is in the the more stealthily applied inflation, that's monetary inflation, where we're just literally debasing our currency at and you can see that kink where you are now. So from the GFC, the eyes roll back, and we've just hit an all-time new record at nearly $177 trillion of global liquidity. So what gold and Bitcoin do beautifully is because fundamentally that is debasement. So what is the perfect antidote to debasement is something that has intrinsic value through scarcity, not something that can just be printed ad nauseum. So that's why gold and silver and Bitcoin do such a wonderful job against that sort of inflation.
Joe, specifically looking at Bitcoin, the correlation we've shown has been very high. Do you think that this correlation maintains over the long term? Is it, it arguably would be higher if Bitcoin wasn't quite as volatile? What's your take?
Yeah, I certainly think that the correlation remains strong, if not potentially stronger, as people realize the role that Bitcoin has to play in as a scarce asset, exactly like Paul was talking about. Generally, as you pointed out just then, it actually would have a higher correlation if it wasn't for the extremes on the upside and the extremes on the downside. So being such a young market, you can expect there to be very high sentiment at times and very low sentiment at times, which would pull that correlation out a little bit. But yeah, I think over time, as adoption becomes more and more mainstream, the correlation will stay quite strong. But that also translates into lower volatility and probably not the gains that we're used to, but still a solid investment in terms of monetary debasement.
And that makes a lot of sense to me, that you can't expect something that's 15 years old or however old Bitcoin is now to compete with something that's 5,000 years old in terms of having everyone on the same page yet. It takes time, but we seem to be getting there fairly rapidly. Looking at this chart we've introduced recently, looking really just overlaying the close price for the week. So this is the close price as it was on Friday for Bitcoin against that weekly global liquidity that we've seen really, really taking off. One of those lines, it traditionally seems to have followed quite closely, and one of those lines seems to be lagging, which I would argue is the Bitcoin line. Is that how you view that, Joe, with the potential tick up to follow that, particularly if global liquidity continues higher? Is that generally your interpretation of what's going on here?
Well, the scale is certainly showing us such quite a large move in liquidity. So you generally don't see Bitcoin react that quickly, particularly when we've had a massive run at the start of the end of last year. There's quite a fair bit of consolidation going through Bitcoin, and sentiment's quite poor at the moment. But I do expect that over the coming months, that blue line is going to pick up with that orange line. Just because the liquidity's picked up doesn't mean that Bitcoin's going to follow it straight away. It's like you said, there's correlation, but it's not one-to-one correlation.
Absolutely, and that I think is a really good point to make, that we could see a general we probably look at it more directionally and not necessarily have the price targets, because some people look at that chart and go, that's it, we go straight to 85. Well, that's not really what this is showing. It's more showing that we've had that move up. So you wouldn't really be betting against Bitcoin here, that's for sure. You wouldn't be anticipating it to go lower, but we don't know exactly where it's going to go, but you would expect that to be providing some support at least.
Absolutely.
We introduced another chart that I'll get you to talk about, Paul, as well, this month, really looking at the global liquidity rate of change and Bitcoin. It really works quite nicely with the next chart, which is the Global Liquidity Index that we use. But really the rate of change, almost as a proxy for that, has been showing pretty accurately where the highs and the lows of the cycle have fallen. Do you want to give us a little bit of background on this new chart?
Yeah, look, I guess to step back a bit, when we look at global liquidity, we're looking at the quantum, and we've seen that in the previous charts. But we're also looking at, I guess, the rate of change and the direction of change. So it's and whilst we're looking at that global liquidity index from cross-border capital, this is another one that we've put together that is all about another check, right? So we're making big decisions based on this, and we want to make sure that we're getting the data right. So what this beautifully points out is, as we're seeing, when it's going up and to the right, we're seeing an increasing rate of change of global liquidity, and likewise when it's coming back, we're seeing that contraction. And you can see really clearly, the correlation with the Bitcoin price. And again, I'll point out that is a log scale to the right. So just to put the scale of what Bitcoin can do into perspective. So this for me is a wonderful confirmation and another tool in the kit for us to make informed decisions about when markets might be changing. And what it's clearly showing now is that air pocket that we've talked about via largely China, the reversal of that. And then, when we look at the length of the previous cycles, nothing there is indicating we are anywhere near the top of the cycle. So again, it's just reinforcing our beliefs and narrative.
And what I particularly like about this chart, from my perspective, is the focus on the real bear markets, if you like, in rate of change of global liquidity, because they're the ones you need to get right. Joe, I'll get your perspective on that. But ultimately, everyone gets excited about the bull market. The bull market kind of takes care of itself, in my opinion, and they last longer, right? Like you expect a bull market lasts for long periods of time as a general rule. But getting that bear market incorrect, that's what really costs people.
Yeah, the money's made in the bear market, 100%. One other thing I just wanted to point out quickly is we've had that recent air pocket, rate of change air pocket over the last few months, and Bitcoin's held up fantastic. Like it's done a fantastic job in maintaining its price. Like it might have seen very, like as Paul pointed out, that's a log scale chart, and it certainly has felt volatile. But in terms of the rate of change of that liquidity falling over since the start of the year, it's performed fantastically. So it's been quite strong in my opinion.
Always zoom out to get the clearer perspective. When we switch over to that Global Liquidity Index chart and we sort of follow that through that last cycle, we've got the same. We've looked at this a few times already today, seeing that really has ticked up. That's probably this is not in a log scale. This is just the average price of the month. It has really been remarkably stable, as you were just saying, Joe.
Yeah, it's basically the same comment as the previous chart, and we have pointed out the last couple of months in terms of the average price holding quite strongly based on the deteriorating liquidity conditions over the last six to 8 months. Last 6 months. It really does get me quite excited for the rest of the year when we know the direction of where that liquidity is going.
Absolutely. We also have this chart. It's been a bit of a choppy mess, and I know we were talking about this just before we started recording. In terms of the cycle work that we use here, just remembering we don't use that for anything other than just sort of give us an indication on timing and manage expectations. Paul, it's it feels like that probably should be the low of a new cycle, but we've got it really very, very choppy when you zoom in at this level. Probably the reason we zoom out on those logarithmic charts, for example, isn't it?
Yeah, and I think that was arguably an exogenous shock, the yen carry trade tantrum. So I think it's we wait and see whether, as you're saying, this is not dictating any decisions right now, and then we wait and see how the rest of the cycle plays out.
But in terms of timing, I mean, we are approaching that point where we would be expecting another cycle to start. So that potentially is the exciting one for the year, where we can, we don't know yet, but where we could really take off and push up towards those all-time highs again. So that's quite exciting from that perspective. We also like to, of course, look at global liquidity against gold, silver, and the GSR. There's a lot going on in the world that we haven't actually talked about yet at the moment, and gold really seems to be responding quite well to that, doesn't it, Paul?
Yeah. I mean, you look at, again, the directions, wash out the magnitude of any of those, and gold's followed it almost perfectly. So it's certainly taking cues, and I guess you have at play a number of forces at the moment globally, and Joe touched on the geopolitical thing. So we've got central banks still buying hand over fist. So we very much have that do as they do, not do as they say dynamic going on. But gold's at record high at the moment, over $2,500, and showing great strength.
And it just like flowing through, looking at silver as well. And remembering these, of course, are the average prices of the month, so you don't get that volatility. But silver has been a really interesting play through this, because it doesn't always like the uncertainty, does it?
No, because it's we talked earlier about all the weakness in the economy, half of silver's industrial uses. So it can feel the drag of that. But again, you look at that chart and it's very much following the liquidity play predominantly. I guess sitting outside that economic weakness is a massive drive in renewable energy, and silver's a massive ingredient to that play. So it may just be shrugging off the weak economy, because the economy that it cares about, which is, I guess, economically agnostic, green energy and medical, and electronics, because we're all still buying our phones, it's shrugging it off. So it's been quite robust for such an early part of the cycle. Silver normally gets its giddy up towards the end, but it's holding strong. And
that may be an indication of promise ahead for that. Like you said, if that's what it's like this early stage of the cycle, we look at this chart with the GSR, and it's actually been quite volatile, which is not really reflected here. But it's gold really did take off with more of the geopolitical stuff that was going on, particularly in the Middle East. But it's, regardless, whichever way you look at it, is still high.
Yeah, and volatile within a channel of 90 to 80, right? So as of today, it's 84, I think. So it's just sitting in there, range bound. What we're really looking for is that breakdown to, that sort of 2011 30 to 1 sort of area to get super excited. We got pretty excited in February 21 when it nearly got 65, but it's kind of noise at the moment, to be honest.
Yep. This monthly macro and global liquidity analysis is brought to you by the Ainslie Group, Australia's trusted choice to buy gold, silver, platinum and crypto online or in our Brisbane and Melbourne showrooms. With over 50 years of operation, we're your reliable partner in wealth management. If you're looking to buy tokenized gold or silver anywhere in the world, check out the Gold and Silver Standard for security of real-world precious metals combined with the flexibility of blockchain. All right, we always love to put in for people this simple trading plan, and we've done this every month. It's a very straightforward plan for people who are looking to take advantage of these liquidity cycles by buying effectively at the low of the cycle when we identify that with our trends and everything we've been looking at, and selling at the high. Bringing up that chart that we were just looking at before, we've got the buy signal in here. We had the liquidity cycle low in October 2022. The buy signal was January 10th, 2023, and we've been holding ever since, which has resulted in some quite spectacular returns. Currently 274% over the past 594 days. So as of today, that's 168.5% annualized, which is nothing to laugh at in terms of a return over that period of time, and potentially about to shoot up quite a bit more if we're right on that liquidity trend as we've been looking at it. So that's our sort of chart-based work done. We've gone through everything and we've identified what we're looking at and what we're thinking about. We'll wrap up today with, as we do each time, everyone's sort of final thoughts on where they think we are. Joe, we might start with you. Your final thoughts, where we are, anything else you think people should walk away with from this presentation today?
I want to reiterate, if you know the direction of liquidity, then you're going to know the direction of markets and the economic cycle as well. And I spoke about the jobs report earlier on, and I hate to be a Fed watcher, but I think a lot hinges on that based on what the Fed's going to do over the next couple of months. So we've got, 7,500 basis points priced in for the rest of the year. And as we pointed out before, the Fed's not even loose yet. So once they really start loosening that, and we see the DXY break under 100 cleanly, we're going to see some liquidity conditions really pick up, and it's going to be quite exciting.
Paul?
Yeah, it's similar. I think I've said last couple of times, watch China. That's certainly the case. I think they've shown their hand, and that their hand's been forced. I really think it's the rate of change of the central banks. I think we'll start to see that really come out to play. So we'll meet again in September. We'll be on the cusp of the that Fed meeting that everyone's salivating over. But I think we're seeing other central banks as well starting to turn. So I think we'll start to see, now that inflation's ostensibly under control, and we're seeing unemployment globally, then you're going to start to see the central banks come into play more so.
I think for me, it's the point that you made before, actually, Paul, with that chart with all the colors. We were looking at the lines, and we've been saying up until now it's been China, wait for them to unleash, and they have done that, and we've now seen the consequence of that. We get a big jump in global liquidity when they start to play ball. Now I actually think we're switching back to looking at the US, and certainly they're getting close. We know that. We've got lots of evidence of that. So that's really interesting to me. I think we'll be watching that very closely, what happens with the US. But at the moment, all signs are pointing to certainly not a pullback in liquidity going into the end of the year. There's no reason to think that's coming. So it is very exciting, like both of you have highlighted. So yeah, that's what I'll be looking at. Thanks for watching our update for the month, and thank you, Paul and Joe, for all your work on that today.
Thanks, Chris. Look forward to next month.
Chris, thanks for having us.
Always value your feedback. You can follow us on YouTube or on X at Tipper Analytics. We do value that. We read all of that, and it does guide how we put this together. So keep that coming. We'll be back again in September with the next monthly update to reassess and identify what's changed. Until we chat again, good luck in the markets.